Hello everyone, welcome to Analysts Insights. We are talking everything capital markets. Our focus as usual is our local capital markets, where we have got the Zimbabwe Stock Exchange and the Victoria Falls Exchange and the Financial Securities Exchange, FinSec, and a number of other platforms that you can use as investors to deploy your capital and earn some return. So I'm joined by a fellow analyst. On my left is Ofaro and on my right is Malvin. Welcome, gentlemen.
Thank you for having us. Thank you.
Good. So there are quite a number of things that we just need to discuss today. But maybe before we dive into all the issues, maybe just a rundown of important news developments that were coming through this week. So there's a report saying the manufacturing sector is on a massive expansion and it is used about 70% of all foreign currency that was injected into the economy. And then also in the news is issues around the prices, which are beginning to creep up. In fact, they're actually increasing quite significantly in Zimbabwe dollar terms. And then there was some news about wheel of the motor industry about to starting assembling vehicles again. And then for the analyst community, I think the important thing was around trading updates and the results that were coming. And in general, we are seeing growth in revenue. But I think someone would ask a question: revenue, how do you measure that revenue in hyperinflationary environment? And recently, one of the other developments on the capital markets is a property company that's going to be listing on the Victoria Falls Exchange, and we were at the briefing yesterday. So I think today let's talk property and property investing and what we are seeing, and then maybe dive into some other issues that are happening in our markets. So maybe taking a step back, it's more an asset allocation kind of discussion that we have. So I'll start off with you, Malvin. You have got a number, you have got some money, call it 100,000. How would you allocate that money, given the asset classes that we have?
Well, it's from my age, look, which is where I would maybe derive my decisions, and also maybe my objectives. I think a lesser portion would be channeled towards property. Truth be told, nothing more than maybe 20%, nothing more than maybe 15%. A greater chunk, I think I would maybe put it towards risk assets, your listed equities, even private equity. Then you need to balance, maybe if I could have exposure to foreign currency denominated fixed income instruments, whether in Zimbabwe, obviously preferably outside of Zimbabwe, I would be happy at that. Then maybe also a greater analysis or microscopic strategy would be more so on the risk assets, being your listed equities as well as your private equity. For the listed equities, I would think I would have I would put maybe bias towards offshore if I could have access, but 100K is not much that you can do with. Yeah, so but more so that would be maybe on the long term. So you want to have a balanced investment portfolio where you attend to the short term requirements, which being attended by the fixed income instruments. On the long term side, you obviously have got the private equity. You position yourself not obviously by yourself, because 100K there's not much that you can do. You actually put that, invest into some private equity funds if you can have exposure, but 100K is not much. That's what I can say.
Many of our viewers might disagree with you about it.
So your response there is you sort of personalized it. So let's say you're a fund manager, you have got a much bigger fund than 100,000, and you are a fund manager in Zimbabwe. Everything, the conditions that we have and the situation that we have on the ground, how best can you allocate your money?
Okay. Being a fund manager, most fund managers in Zimbabwe, they managing pension funds money. So this is your retirement funds, and a lot of the retirement funds in Zimbabwe at this stage that we are discussing this topic, they are mature funds. Very few of them would be maybe your average ages of say 33, but most of them you've got the average age profile being more than 40, 45. So they're going towards retirement. So they can't lock their investments into long-term investments or into very risky investments. So with that strategy, I think the most important thing that you need to think about is capital preservation. Capital preservation in our market is not, it's really hard because of a lot that is happening on the currency front. A lot that can happen maybe to disturb an investment, maybe due to a statutory instrument or anything. So with that context, I would say looking at we need to hedge the country risk profile because of so many things that can happen when we don't know. So how best can a fund manager hedge such risks? Take advantage of the 15% investment window which was given by IPEC to invest offshore. Sure, if they are receiving US dollar investments or contributions, they need to be able to take advantage of that window. If they can't, they are also still, if they're not really getting the hard US dollar contributions, there are ways, quite innovative and very clean, legit ways that a fund manager can also have exposure to offshore investment markets, but also maybe juggling around the assets that they have from the Zim dollar perspective. But besides the capital preservation, it's really, you also need to obviously look at the listed equities. A lot of the counters right now on the ZSE, I would say they are undervalued.
Okay,
And
so according to Marvin here, a lot of counters are undervalued. Rufaro, maybe I just want to get your assessment. How do you assess the asset allocation strategies of the local capital market players in terms of maybe what you see as the common trends maybe in the last few years, in the last few months? And do you think that that's the right way of deploying funds given whatever macroeconomic conditions that we are facing?
Yeah, so from a Zim dollar perspective, the fund manager is basically in a conundrum because we are in a hyperinflationary environment. Every day that you actually sit on funds in your bank account, they are being ravaged by inflation. So you are under pressure to deploy them as quickly as possible into an asset class that will not lose value as fast as the local currency. And in terms of your investment destinations that can quickly absorb Zim dollars, the ZSE is probably the most attractive because firstly it's got very flexible ticket size. So whether you have 10 million Zim dollars or 100 million or a billion, you can very quickly deploy Zim dollars. Whereas on the property market, for example, it's very difficult to actually conclude transactions in local currency. And the very nature of private equity requires you to do due diligence and other paperwork that takes time. You can it can take you up to 60 to 90 days to close a private equity transaction. And if you're sitting on the Zim dollars over such a period, you could actually lose a significant portion of that value to inflation. So the bias on the Zim dollar side for sure is to quickly deploy onto the ZSE, and then if there are other opportunities that are more attractive, you can then switch out of listed equities into a private equity transaction or another opportunity. There isn't a lot of nostro available to the capital markets from what we're seeing in terms of transactions on the Victoria Falls Stock Exchange. Although we are aware that on the property front, transactions seem to be hard currency denominated. But in general, it looks like property in Zimbabwe relative to other countries in the region is overvalued. And I suspect this is because there's a lot of trapped capital in Zimbabwe that's not comfortable crossing borders and exploring opportunities elsewhere. And to the extent that capital is in hard currency, there's a bias towards property. So also the other reason why there's a significant bias towards property is because if you have title, you are able to borrow against it in Zim dollars, and that carry trade has been very profitable over the last 2 decades. So notwithstanding that you might be paying more than fair value for a property, having that collateral opens up other opportunities that can be very lucrative. So a lot of hard currency you find is then deployed in the property sector.
So is it why we are seeing a proliferation of projects that are taking place, especially around Harare? A lot of cluster developments are taking place, and whichever corner of Harare that you go to, especially in the high income areas, there's a lot of development. And maybe I just wanted to get your views on what does it say in terms of the thought process behind that development from the people who are participating, and what kind of investor are we seeing mostly? Are we seeing big institutional players, or it's individual? And if it's individuals, why? And I don't know if they would agree with you, Rufaro, about the sentiment that, or the view that the property sector in Zimbabwe is overvalued. What are you seeing, and why do you think is driving that activity?
Okay. I think we need to look at it from so many angles. Obviously, if you're looking at the lower end of the market, the key driver has really been your low income earners. They will buy the 30,000, 40,000 property, or they develop. Why there's been a very big thrust or push towards maybe acquisition as well as development. As you would know, there's been a sort of some disintermediation of the financial service sector, especially from the pension fund side. So one is probably developing a certain residential property in the hope that that will be their source of maybe retirement income. Having been banned maybe somehow, people would say, look, you know what, that's a safer investment for them. So a lot of those developments, they are taking place because of the need maybe for them to secure their financial future. It might not be necessarily maybe to be staying there. Then obviously you've got others, they are pushing, maybe they're tired of paying the rentals. They want that security because maybe their job, there's not so much job security at the moment. With formalization, people are losing jobs and what have you. So from that perspective, that's why you're seeing a lot of activity happening on that side. Then if you look at the other end of the market, where you see the northern side of town, those developments, the key driver has been, like you alluded to, the trapped money, which is trying to seek for safe destination. Safe money, maybe trapped money, maybe from payments that could have happened, maybe through someone in a tender, a huge payment comes through. There is no way maybe that they can easily sort of maybe allocate that capital. So they'll go either to the stock market, or if they are not so sophisticated, they will find home safety in a property development. Having said that, what it has done now is that to say, look, it has pushed prices beyond maybe logic or rationality. So if you make comparisons in terms of our properties in Zimbabwe, you put up maybe you got 100,000 US dollars. If you translate that maybe to about 1.8 million rands, you'd get a better property in South Africa for 1.8 million rands. It's better than what you'd get maybe for your 100,000 KZN. So what has been pushing is really, it's a game of demand and supply. There's been a bit of some artificial demand.
So by artificial demand, are you saying those new developments or properties, they are able to get some tenancy, or maybe the investors are just building to park their money, and then maybe they don't have to worry much about tenancy? What has been the experience? I know it's very difficult because these are private sort of projects.
So if I can come in, so when he says artificial, if you look at other markets across the world, your natural demand for property is, certainly on the residential side, is homeowners buying property via mortgages. That's typically how your average citizen across the world purchases a home. Now, because of the macroeconomic environment in Zimbabwe, most ordinary citizens don't actually have access to a mortgage. So, and yet you see all this construction in the residential space. So I think that's the point that he's making, in terms of it being artificial demand. It's not your natural demand for property. It's really trapped capital, or somebody who's buying a property as an investment, not to live in, for the most part.
So maybe a question that may arise is, so you're alluding to the fact that because of the informalization and the fact that we don't have the macroeconomic environment is not supportive for your savings and investment schemes that are driven by institutional players. So individuals are having to make plans for retirement. Is it good for the country, though, where individuals are making own decisions around that area? And are they skilled enough? Because besides they only limiting themselves to just property, are they going to get the most for their retirement from their retirement pot by just putting their money in the property? Are we saying there's no more role for institutions to play in terms of helping with savings and investments for retirement for most of us here?
I don't think that it's I can't say I don't think. Certainly it's a fact. It's not a good thing where we are in such a so the capital market has been sort of disintegrated, and likewise the economy is heavily disintegrated. There's no system or platform to be able to harness capital at large scale. So at the end of the day, when that happens, you've got it's too much micro. So we've got I call these houses micro pension plans. So with the micro pension plan, like say someone decides to invest into a house maybe in high density suburb, that's not a good thing. Ultimately, yes, it's a safe thing, but to be able to get the best utility for their retirement life, it won't be the preferred way. Why? First of all, how many people can be able to say have a house and other investments at the same time? So in most cases, they are going to look at that house as their sole retirement income, and that's, for me, that's basically a heavy concentration risk. So should anything happen to that house, should anything happen to that neighborhood, it's going to affect their lifestyle. We have seen situations where if maybe there's a blackout maybe for 2 years because maybe a transformer in that neighborhood is down, the rentals are likely going to go down. So at the end of the day, it's not a preferable thing to have maybe one source of income, totally reliant on maybe one asset class. Not only that, as you know, property by its nature, whether in Zimbabwe or across the world, it's got a very low return on your investment. So the way they are going to accumulate their, maybe to get their capital back, as well as maybe to just generate maybe the much needed income, it's not going to be at a good return for their income. Property, I think, for one to think about property, it's at a later stage in your life where you've arrived, but not to say, look, this is your sole source of income when you retire. Otherwise, you become a nuisance to your tenants.
Because you always have to make sure you are covered from the rent, even if it's it won't be enough.
So I'll also add to his comments. I think that the challenge with what the harm that we've done to the pension fund industry, through this macroeconomic framework that we operate in, is that that capital in a normal economy that's going to pensions would actually, your fund managers are looking for alpha, and it would be directed to the most productive sectors of the economy that offer the highest return on investment. So entrepreneurs would have this pool to draw from to build their companies. And so one of the challenges in Zimbabwe today is that it's very difficult to actually get funding, either as equity or debt, to drive business growth forward, because all this trapped capital doesn't have a channel to find its way in startups and fledgling businesses. And then also, I think the other thing that's happening, and I see it happening in the northern suburbs with a lot of these cluster homes, it doesn't look like there is a clear vision from city planners in terms of how to accommodate the demand for residential, for accommodation. And what you'll find is, so in a neighborhood like Mount Pleasant with homes on 1 acre, right? You get these developers who come through, and then they build 10 or 20 units on that 1 acre. And what and what I don't think has been thought through is the reality that the suburbs and the roads that feed into them were designed for 1 acre homes on 1 acre with maybe 2 cars per home. And now you have a 10, 20 unit cluster with 1 or 2 vehicles per unit, and they're mushrooming all over the place. So it looks like we're baking in a horrible traffic problem into the next 5 to 10 years, which is because these developments are just being signed off without, thinking through the long-term impact of having, all these clusters develop.
Okay. So if I could maybe just speak from what Rufari is saying, ultimately in terms of sustainability from an investment case, we might have the situation that we currently have in terms of properties in the CBD where, look, they might not be that attractive maybe 10 years from now. We might start seeing people moving out from these cluster developments. We might see people not getting their best return. So I think the discussion somehow, it's food for thought for anyone who want to invest in the cluster development, not just from a profit or investment perspective, but also from a residential perspective, from a long term. So if it's a starter home, I think a cluster home development for one to stay, it's not a bad thing. It's a starter home. But ultimately to say, look, this is our ultimate. I think so much due thought has to be given to it.
So what needs to happen for those funds to start actually flowing into institutions, and for the public to start having confidence that if they leave their money with institutions, it will do a good job of creating a safety net for them in their retirement? Because I'm trying to see if we should not come across as blaming the people for trying to do something to safeguard themselves, given our history with losing money for people who are saving and investing. So what needs to happen?
Look, it's a long, hard road. I think the problem with, they say about reputation that you earn it in drops, but you can lose it in buckets.
Okay.
And, so it's once you've lost the faith and confidence of an investment community, it's a long, hard slog to correct it. It's kind of like, if we think about the Zim dollar, for us to get back to a place where people are happy to receive Zim dollars and just leave them in a bank account earning interest without worrying about losing value to inflation, I think it could be a decade of doing the right thing before we get to such a place. And I think some people are so traumatized that for the rest of their lives they will not be comfortable keeping savings in a bank account. And sadly, I think the same applies to the pension industry. I don't think there is a quick fix. I don't think there's overnight we're going to wake up in a dispensation where the average citizen is relying on their pension or believes that it's going to give them a decent retirement. I think it's a long, hard slog of doing the right thing, and we are 5 to 10 years away from a place where it will be a normal industry again.
I think referral you set maybe a very good context as well as maybe a framing, possible roadmap in terms of maybe how to make things better for the industry as well as for the people. I would maybe pick from him, from the side of maybe the stakeholders, which are the pension fund stakeholders, the service providers. There has to be like serious thinking, largely innovative, and to respond to the dynamic nature that is the case now with our country. So I'll give you an example. Normally, say if someone is to retire, they retire at 60, they'll get a lump sum, which is normally a third of their pension pot. So for that third, in terms of maybe assuring maybe a certain monetary value, they need to speak to say, look, come up and say, look, you're going to get maybe 1 unit of a certain property. So whether you're going to get maybe a coalhouse in the high density suburb, that sort of assures, or you're going to get maybe 100 cattle. So that people, instead of maybe them having to think about maybe investing into cattle today, they think about, they have this idea, look, not upon retirement, I'm going to get, say, 10 or 20 cows. So for that, I think we have to speak about maybe people want the tangible assets at the end of the day for their capital values. Then also we need to sort of index whatever monthly payout that we're going to be giving to these pensioners. Let it be indexed to something. Whether it's going to be looking at, we're going to give you X amount of 30 loaves of bread every month. We're going to give you maybe medical aid, post-retirement medical aid. You're not going to be paying anything, so that they can have confidence to say, you know what, I've signed on. My children, maybe they are secured in terms of maybe their schooling, whether it's high school. They don't have to be paying anything. So look, they say, look, that pension fund can sort of maybe have shareholding in a particular school, or it can actually construct a school, such that if anything happens in the monetary scene or maybe in the fiscal space, the pension fund is hedged against such risks, because already it doesn't need to draw upon maybe its own finances or its own money to pay out. It's actually got a hard asset that it can rely on. It's a first port of call which it can hedge against should things not happen. Maybe they lose bank balances through some maybe treasury bills, maybe they've been really depreciated in terms of value, they've been discounted. So at least if anything happens, they've got a hard asset to say, look, you've got the school, you've got the clinics. Because a lot of the times, pensioners, their major expenditure, it's really medical care. So let's speak about post-retirement care, and we think about actually crafting tangible solutions which can speak to what they would have paid for had they been given money, so that we can secure it now, make investments which are socially viewing, or in terms of maybe their pensioners' needs. Otherwise, being in the monetary space with flip-flopping policies, I think it's a risky game, which maybe might not warrant maybe the much needed confidence from the market.
So Malvin, is that a tailor-made solution for Zimbabwe, or maybe there is some markets that have got those kind of products? Also bearing in mind that a pension fund will be looking after so many beneficiaries and who may have different interests. Probably some of them already have got houses in the cattle that you're talking about. They may not find some of those sweeteners attractive to them. So first, the question that I want you to answer is there evidence of such schemes or products elsewhere, or maybe it's a tailor-made solution? And how do you then deal with the fact that we are dealing with thousands upon thousands of beneficiaries who may have different interests?
So I would speak to say, look, my response would be like, it's a hybrid case. One is it's a tailor-made approach for Zim, because Zim has got so many unique positions. Then on the other hand, there are best practices globally out there where things like that have happened. If we look at South Africa and UK per se, if you got the UK pension structure, they've got more like a dual system where, look, in terms of investments, there's the group structure, then there's the individual choice structure, where it's to say, look, an individual pension fund member can be asked to say, look, what kind of leaning would you want to have your pension pot towards it? Is it going to be, are you a risk-averse person or a very conservative person? So if they are a risk averse person, sorry, if they are a risk conscious person, who are a risk taker, I would say, they can have, they are given their pension pot can have a greater link towards your listed equities, such that, look, the decision is inclusive. They are not going to blame anyone at the end of the day. Then if they are very conservative, their pension pot is going to be put into that sub portfolio where it's leaning towards property, fixed income, and what have you. So at the end of the day, if you find that already, what I'm trying to suggest is already mimicking maybe global best practice in the UK. You've got the SS side in terms of healthcare, post-retirement medical. Okay, it's already there. These are things that they've already done. And is it that sometimes as Zimbabweans we are slow to move, or we are rigid in terms of maybe how we go about things? We're trying to just maybe do things the same way, but when circumstances have changed.
Okay, so Rufaro, do you agree? Do we have to tailor-make solutions, or maybe the macro has to be good so that we are just like any other economy where people can save and invest, and then a fund manager or institution is allocating funds on behalf of the members?
Look, I think as long as there is no clarity about the macroeconomic environment, I think the quickest way to restore faith and confidence is to actually offer people non-monetary benefits. To say to somebody who is just starting out in their early 20s that 40, 50 years from now you're going to get a monetary Zim dollar pension is not going to engender any confidence. But if you were to say, look, when you turn 65, you're going to get a 2-bedroomed at your current salary level. If you keep contributing for the next 45 years, you're going to be entitled to a 2-bedroom flat, and you're going to get a medical aid card that ensures that you get healthcare for the rest of your natural life. Then that's something that's tangible that they can wrap around their brain, and they can be committed to that. Whereas if you just say, look, it's going to be some amount, we don't know what on your 65th birthday, your 1/3 is going to be, in terms of value, and what your monthly stipend, is going to be. And also remember, this person starting out in the employment or in business, they probably have a grandmother or older relative that worked for 40, 50 years and is almost destitute because their pension is worthless. And so if you use the same language to sell them a pension story that was sold to the current generation that is almost destitute, you're not going to sell. People right now, I think a lot of employers and employees, the pension contribution is, I think the mindset is that it's just an additional tax. If I'm really, really lucky, this might be worth something, but but nobody's actually sleeping better because they're making this contribution that is going to look after them in their old age. Everybody understands that these things might be worth nothing, and you have to have another plan. So I think your language makes a lot of sense.
Anyway, wow. Thanks so much, gentlemen. We're supposed to give some confidence to our viewers. You guys are experts, but I think the main takeaway is that we have to be innovative and be able to create solutions that make sense in our environment. And to our viewers, we want to hear from you. What do you think we should happen? How can we best, as a country and as an economy, save for retirement? Because certainly retirement is coming, and you need to plan. I think Malvern have raised a very important issue that the biggest expense at retirement will be related to your health, which obviously will deteriorate with age. let's hear what you think, how best we can, some solutions that you think would work, and possibly make things a bit more comfortable for all of us. Otherwise, thanks so much for watching, and keep investing and invest in your future. Thank you very much and have a good day.
Cheers.